The views and opinions expressed on the following program are not necessarily those of the staff and management of KLAY or those who advertise their products or services on this station.
Locking it in with Deb and Pear. I'm Deb, the Real Estate Sherpa with Coldwell Banker Bain in Puyallup, Washington. This program is a resource for information on all things related to real estate. We'll be talking with industry leaders about a variety of topics. It's important to keep in mind that every situation is unique. So please, always seek the advice of a properly licensed professional before applying any of the information shared here. And in no case should anything we say be interpreted as legal advice.
Fairway Independent Mortgage Corp., NMLS number 2289, is an equal housing lender. This is not an offer to enter into an agreement. Not all customers will qualify. Information, rates, and programs are subject to change without notice. All products are subject to credit and property approval. Loan officer NMLS number 173529.
All right, welcome to Locking It In with Deb and Pear. I'm Deborah.
I'm Pear.
And we are here in the studio today with
Aric Walker.
Our brother Aric Walker.
How you doing?
Yeah,
Oh my
you're doing great there.
We're in for a real treat today.
Yeah,
yeah.
it's going to be extra special. Yeah, so Aric, what do you specialize in?
Well, I work with mainly seniors. What I do is I work with a company called Virtue Capital. I'm a registered investment advisor. So I work with folks in regards to their stocks, their bonds, their mutual funds, those kind of things. But I also have an insurance license, and I work with a company called the Thomas Group. And so it's a lot of different things to help people that are usually 55 and older.
Okay, great. Thank you. And we'll be talking with him a little more throughout the show today. First, how about a follow-up from a story we did last week about the Brady Bunch house? Remember that it was listed for sale in July for $1.88 million.
It's
Quite a
sold for-
hefty sum.
Sold for 188, right? 188,000.
No.
Denied.
Within days, it was listed July 21st, and within days, this is weird because I just looked at the listing last weekend before the show, and it said active. But within days of bidding, there were multiple offers well above list price.
Oh, you're kidding.
Was that Greg that bought it?
No, it wasn't
No?
Greg. No, one of the offerers was Lance Bass. I have never heard of him before.
Oh, he's one of the new kids on the block.
I think it's NSYNC.
NSYNC. Okay, one of those guys.
Yeah, one of
The
those
boy things.
bands.
I'm a
Yeah.
rocker, so I don't know those.
Yeah, I don't either. I had to look it up. So, ultimately, the winning bid went to HGTV.
How much did they spend?
They paid $3.5 million.
You are kidding me.
No, for a house, of course, that needs a lot of work. It's 1970s.
I'll bet you that was a renovation loan, and they're really only spending $100,000 on the house, and the rest of it's going to be renovation.
Marcia.
Well, I would like to know by the time they're done filming it and remodeling it, I think it's probably going to cost like $4 million. Anyway. I don't know I know how much it costs to remodel. I don't know how much it costs to film. I imagine it's a lot more than the remodeling. So last week we did the Ketron Island story, and we delayed our discussion on the 6 phases of the mortgage loan process. We were going to talk about step 1 last week. We'll do that this week. So, Perrin, why don't you remind us again, what are the steps?
Okay, the first step in getting a mortgage or in buying a house is getting pre-approved for your mortgage. That that involves going and talking to your loan officer and giving him or her your personal information so he can do a basic application on you, as well as giving your income documentation to him. The next step is house shopping with the realtor. The next step is doing a full mortgage loan application. That includes getting disclosures such as the loan estimate and so on. It's not as bad as escrow in terms of signing all those documents, but it's probably 30, 40 pages. The next step is loan processing, in which the processor proves and documents all of your information, social security number, all that other stuff. The next step is underwriting, in which an actual underwriter actually approves your loan. And the final step is going to loan closing and signing those 100-page documents, whatever they are.
100-page?
Maybe.
And being on the hook forever.
No, just 30 years.
Oh, okay, good.
Oh, so and you're not agreeing to have your mouth sewn to someone else's. Yeah.
Depends on the loan.
Okay.
We can talk about those lenders in another show.
Okay, good. Okay, so the first part, pre-approval. This is really important for me as a realtor. A lot of times, buyers will call me and they'll want me to show them a home. And I have no idea, if they can even buy that home. And it takes a considerable amount of time to show homes. I have to drive. I have to, do a little research.
Costs a lot of money and gas, huh?
Yeah, and the time I'm spending with them could be better spent with another buyer who already knows what they qualify for. Even if they do qualify without a pre-approval, I can't make an offer.
Yeah, the seller demands a pre-approval letter, don't they?
Well, the seller is going to say, "Well,
agent.
How do I know they can pay for this house?" Well, they need the pre-approval to see that. So it's kind of a moot point to show a buyer a house without this essential piece. How then should the buyer proceed in this case?
Yeah, they need to talk to the loan officer. They need to give the loan officer their income and documentation, and they need to give the loan officer basic information for an application so the loan officer can pull credit on them, and so that the loan officer can put their debts and their income together and do an analysis and come up with the right amount of money that they can actually afford.
Okay. Sometimes I see something called a pre-qualification. Can you explain the difference in the pre-qualification and a pre-approval?
Pre-qualification is like a 2-minute pre-approval, but pre-qualification is really not worth the time that's spent on it. It's just basically no credit is pulled, no documentation of income is given. The buyer does tell the loan officer how much he believes he makes, but the loan officer doesn't really.
They don't even verify the stuff.
So there's no proof of anything. It's
There's
just
no proof.
a conversation between the buyer and the loan officer.
Right, and it's really not very effective, and the seller's agent will normally not accept a pre-qualification letter in order to make an offer.
Okay. Yeah, see, I've heard of them. I've actually never seen one. I don't think they're too common anymore. I don't know.
No, they're not.
Okay.
Pre-approval is the way to go.
So what's involved with the pre-approval again?
Basically, the
underwriter gets involved?
sometimes.
Okay.
The there's such a thing as a desktop underwriter where it's automated, where the loan officer can go to Fannie Mae, Freddie Mac's websites and actually get an automated approval if the credit is really good, that kind of thing. Sometimes it does take more in-depth study, and the underwriter is involved.
So there's a greater level of confidence with that pre-approval.
Absolutely. There's complete confidence, hopefully.
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 There still might be things that'll come up.
Well, a complete loan takes about a month normally to do, sometimes faster. But during the whole process, a lot comes out, and so there's a lot involved. So a pre-approval is a pre-approval, and a final approval is something else.
Okay, so how often does a pre-approval fail to result in a final approval?
Not very often.
Okay, good. Okay, I had another question. I just lost it. All right, so we will be back right after these words.
My favorite thing about music is it's reliable. It's always there.
There's nothing to worry about when you do music. It takes my mind off of all of the worries that I have in life. You're just having fun.
When I'm playing it, I'm like, wow, this is me. I sometimes just like shock myself.
I didn't have anywhere to belong yet. If I played drums or, if I played guitar, I played bass, or I sang, I felt like all of a sudden I had a community behind me.
It's wonderful that I'm part of something that brings me great joy.
And it just helps me cheer up other people.
You're kind of in communion with something that's a really subtle and beautiful thing of creativity.
And the sound just increases around you, and you just become immersed in it. You become one with it.
When you play music, you are playing life.
Whatever music means to you, just play.
Brought to you by the NAM Foundation.
Look at all the cars. Lots of colored cars. Ah, there's a blue one. Isn't it pretty? Whew, look how fast that red one's going. It's red like that stop sign. Like my jacket.
This is a 38-year-old man.
My jacket's not a car, is it? Is my jacket a car? My jacket is red, but it doesn't go fast.
He may sound a little strange to you and me.
Vroom, vroom, vroom.
But to his 2-year-old son, who's interested in cars and colors, he makes perfect sense.
That's the sound cars make.
When you talk with your child, you build vocabulary, and learning starts long before school does. So follow their lead. Take simple everyday moments like eating dinner or just watching cars go by and turn them into learning moments.
Ooh, look, red car.
Yes, and it's moving awfully fast.
Blue car.
Yes, the man in the red car is about to meet the man in the blue car. Get himself a pretty pink ticket.
Turn everyday moments into learning moments. For more tips, go to bornlearning.org. Brought to you by United Way and the Ad Council.
This is the story of a boy wizard whose name was Larry Smarter.
Larry, why weren't you in Professor Dinky Doodle's mythical creature classification class?
Larry wanted to go to college, so he visited knowhowtogo.org to find which classes he really needed.
You missed the lesson on telling dragons from dragonflies.
Right. I want to go to college, so I'm taking Algebra 2, Biology, and a foreign language.
Foreign language? You mean so you can talk to unicorns?
Well, not exactly. Unless they're French.
But Larry had no time for unicorns, or even for Miss Petunia Tuti's time-traveling tutorial, which met every other yesterday at 25 o'clock.
Sorry I'm late. My snarkball game went into overtime.
And he knew knowhowtogo.org was way better than hoping for a snarkball scholarship. So, while his friends all aced invisibility, when Larry finally got to college, they were nowhere to be seen.
Brought to you by the American Council on Education, Lumina Foundation for Education, and the Ad Council.
All right, welcome back to Lockin' It In with Deb and Pear.
Oh, yeah.
We are in the studio today with Aric Walker. That was him. If you enjoy our show and you would like to leave us some feedback or ask a question, you can visit our Facebook page at Lockin' It In, or you can reach us direct, 253-226-6454. Okay. Welcome, Aric.
Thank you.
Yes. Remind us again what it is that you do.
Well, as a registered investment advisor and as an insurance broker for life and health, what I do is I focus on folks that are 55 and older, helping them make sure that their retirement can be the best possible. One of the focuses that we have in my office is how to get the IRS out of your retirement. So, for example, when we look at folks that are 55, 60, 65, 70, at a certain point they have to take money out of their retirement plan. That's at age 70 and a half. So we help them make sure that we can plan in advance and get the taxes out of those plans, out of those IRAs, those 401ks, and those kind of things, so that they will have more money for themselves while they're retired. But when we were talking earlier in the week, we talked about one of the big pitfalls that deals with housing and folks that are in retirement.
Yes.
And one of those pitfalls is chronic illness. So if a person has an illness, and usually it doesn't happen to people till they get into their late 70s or into their 80s, where they start having some difficulty. And they want to live at home. We all want to live at home. We don't want to go into a nursing home. Nobody wants to do that. But what needs to happen to give people more flexibility and to make sure they have enough money or assets to deal with some of the chronic illnesses that come up is they need to look at something called long-term care insurance. What you don't want to do is have the situation come along where we're just going along in retirement, everything's going fine on Monday, and then on Tuesday or Wednesday, one of us falls and we go to the hospital and our spouse is not able to take care of us. So, for example, my wife wouldn't want to lift me, and there's certain things that are...
Well, you weigh like 400 pounds, don't you?
Well, I'm down to about 380. So,
more like 120.
Skinny guy, it's like 160.
Yeah, 160 is probably good. Yeah. But anyways, it's difficult for the spouse to take care of us. So there's the lifting, there's the changing clothes, there's the whole, we call them the activities of daily living.
So maybe you might even need to remodel the house to accommodate.
So there's that, and there's a lot of things that are involved with this. Just recently, with the Tax and Recovery Act that was passed, this is the new tax law. And that's a great deal for individuals and for businesses, but it sunsets in 2025. And so right now would be a great time for people to kind of look at, well, am I in the right house? And this is an area, Debbie, that, we hadn't talked about it before, but this is an area you can help people that are approaching retirement and that are in retirement. They might want to decide, hey, if I have...
Time to downsize.
Yeah, or I have a house that I'm on 2 or 3 levels. I might be fine today, but 5, 10, 15 years down the road, I might not... My back might give me trouble. I might have balance issues. It might be a good idea to look at downsizing or changing my residence to something that I'll feel comfortable living in the rest of my life, so that I don't have to hire help, so I don't have to do all sorts of different things, and I can feel comfortable in my home. So that's something that you might be able to help people look at. But there's another issue that's even bigger. It's kind of like the scary, crazy aunt in the basement. We know she's there, but nobody wants to talk about her. And this is when you need chronic help. So the situation happens to, it's actually about 70% of people age 65 and older at some point of their lives will need help for chronic illness. And so what ends up happening is they either have long-term care insurance or they spend their assets off down to almost nothing, and then they have to go into a care facility. Now, there's lots of different options. If you have a ton of money, you can just self-insure. That's maybe not the most efficient thing, and I'm sure that the kids or the grandkids that could have inherited that money wouldn't want to see you just have to blow it all on care. But, you do what you have to. Sometimes people will look at something called long-term care insurance. And that's kind of a landmine too, because there are tons of different policies out there. There are good companies that do it, but the costs can be prohibitive. And some of we call them traditional long-term care insurance policies, they end up having price increases every 2 to 5 years. And
now,
so,
how long are they for? I heard that they were like for 2 or 3 years.
and you can only get
anyways.
2 or 3 years of benefit from
well,
them.
yeah, that's a good point. How much benefit do you need? Well, let's take a look at that. Typically, a person who needs long-term care insurance will need it for just under 3 years.
That's amazing. I would think it would be like 7 to 10 years.
Yeah, the reason I think so too is because, well, I was in high school at the time, but I used to work in nursing homes, and there were many of them who were there for 10 years.
Yeah,
I mean,
that's
lot
true.
of them, and they were the majority.
That's true. The average is just under 3 years, but that does not include the person who needs some help at home for several years.
Doesn't mean anything.
It doesn't. And averaging is dangerous because averaging doesn't really take it. The person who's going to need it for 14 years because they have Alzheimer's, or the person who, they start out at home and they need help at home for 5 or 6 years, and then it gets to be too difficult and they have to go to an institution. So the average is out there. What we like to look at in my practice is making sure that whatever the individual's doing is A, affordable to them, and B, it will last for their lifetime if possible. So there are new tools and new products available today that allow the individual or the couple to have, in some cases, a lifetime benefit. One of the companies we work with will give a lifetime benefit for a couple.
Really? How much does that cost?
Well, what it is it's a hybrid. So it
get
takes
life insurance.
It gives you some life insurance. It's what's called a second to die. So the policy is really built for the couple to give them long-term care insurance, but it's built not as a use it or lose it. Our car insurance is use it or lose it. If I never have an accident, which is what we all hope for, then I paid for this insurance and it gave me a good feeling that I had it, but I don't get any benefit afterwards. This hybrid type long-term care insurance, what it does is it says, me and my wife are covered, and if we don't use this benefit or don't use it all, then there's, after we pass away, there's a benefit that will go to our loved ones, our beneficiaries. And it's actually double or triple what we put into it. So we can pay monthly, or we can put taxable assets into it, like an IRA or a 401k. And if we need long-term care, those will not be taxed. Uncle Sam, through the different laws that are available, the Pension Protection Act, for example, will give us the ability to spend that asset for long-term care, and the company that does it gives us the ability to have a lifetime benefit. So it'll last for my lifetime, my spouse's lifetime, and
if you and your spouse both need long-term care for 5 years, 6 years,
lifetime.
Yeah.
So it like Perrin was saying, some of these policies will give you a 2, 3, 4, 5 year benefit, which is not bad, but you might run out of benefit. They have a defined dollar amount of benefit.
Yes.
And this other type will give you a lifetime benefit. It's a pretty good policy. It's not for everyone, though.
A lot more expensive, right?
It is expensive. But if you have assets that you're using as your emergency fund, those can be used for it. And here's the kicker. If somewhere down the road you change your mind and you want your money back, you at least get the money you put into it back.
That's what my question was. Now,
So it does keep a cash value.
We went on an appointment together about 2 years ago, year and a half ago.
Yes.
And you were talking about that to the lady that you were talking to.
Exactly. So it allowed the person who has extra assets that says, this is my emergency money, to say, hey, I'm going to take this money. It's going to cover me and my spouse, or just me, for long-term care. If I don't use it, it'll go to my loved ones. Instead of as a taxable IRA, it'll go to my loved ones when I'm gone as a tax-free death benefit that's double or triple what I put into it. So it's cleaning that money up. Again, we're going back to, we want to get you out of Uncle Sam's pocket. So it gives you that opportunity. But there's new things that have come out within the last year or two. There are, I'll just say the dirty word, annuities, that allow a client to grow their money, use it for income, but if they need long-term care, some of these are built to give them double the income for long-term care. For one of them we have gives it for 5 years. Another one gives it for until their cash balance runs out, and then it goes back to the annuity where it pays them the regular lifetime income for the rest of their life. So there are a lot of great tools. You don't have to buy a long-term care insurance policy and just hope that you're going to have to spend the money for long-term care. And if you don't use it, then the money's wasted. You have the ability to grow your money, use your money to enjoy for your retirement, and if bad fortune hits you where you need that long-term care, then you have this extra benefit kicking in. We call them hybrids, and they have extra tools.
I got a question for you, Aric.
Yes.
At what age would you recommend that I start looking at long-term care policies?
So what we do is we do a fact finder with all the people we talk to. And what we're looking at is you need to have some retirement funding already built before you look at long-term care insurance. Long-term care insurance protects your assets and protects your ability to choose as an individual or a couple what you're going to do and where you're going to get help later in life. So a short answer to that question is, if you have children, after you've planned and taken care of their college education, and after you have done a pretty good job starting to fund your retirement so that you know that you'll have, in addition to Social Security, you'll have assets that will give you a good standard of living. At that point, I've had clients who are mid-50s that are ready to start looking at long-term care insurance. Others, I've told them, well, let's fund your retirement first, and then once you have a good amount of that retirement funded, then maybe you'll be 60, maybe you'll be 65, maybe you'll even be 70. Even sometimes into the mid-70s, we will look at long-term care insurance through these hybrid type of things, and sometimes through annuities to give them that extra benefit without extra cost.
Okay. Great. Thank you, Aric. And we'll continue our conversation with Aric when we come back.
Excellent.
Hope you enjoyed your meal. And I just want to say, he's lucky to have a brother like you.
Lucky? Caring for my brother is far from easy. Waking up every day, lifting him from the bed to the wheelchair to the car to get him to therapy on time, it's no small task between the doctors and the diagnosis, but nothing can disable this love. This is my big brother, my hero. He's part of me, like my arms and legs. So I'll be his. See, there's no time for tired. This starts again tomorrow. He'll be waiting for me. I wake up for him. I know he needs me, but I'm the lucky one. Even though I need help now and then.
If you're caring for a loved one, visit aarp.org/caregiving for care guides and community, or call 877-333-5885. Caregiving Resource Center. Support for your strength. Brought to you by AARP and the Ad Council.
You wanted to see me?
Yes, please, have a seat. So here's the thing. When this company brought you on, we took a chance on you. You didn't have that 4-year college degree we typically look for.
Right.
But we gave you a shot anyway. And since then, you've worked incredibly hard and given it your all.
Thanks.
You've been an important asset to the team, but I don't think you can be an intern here anymore. We want to hire you.
You're serious?
Absolutely.
Find your next great employee. Introduce yourself to the grads of life. Who are they? Talent worth knowing about. Young adults of unique determination and experience. An ideal fit for your company in an entry-level position, internship, or even mentorship. They might not have every qualification you typically look for, but they're exactly who your company needs.
I won't let you down.
I know.
Don't miss out on a resource many innovative companies have already discovered. Go to gradsoflife.org to learn how to find, cultivate, and train this great pool of untapped talent. Brought to you by the Ad Council and gradsoflife.org.
Perrin Walker Fairway Independent Mortgage Corporation provides national strength and hometown service for you when you purchase or refinance your dream home, investment property, or vacation home. Contact Perrin today at 253-226-6454 or apply online at perrin.walker@fairwaymc.com. Fairway, we serve people. Fairway Independent Mortgage Corporation, NMLS number 2289 is an equal housing lender. LO NMLS 226890. This is not an offer to enter into agreement. Not all customers will qualify.
Dear John, I'm leaving. Uncontrolled high blood pressure is serious, and I can quit whenever I want. Why can't we get back to when you checked on me? I don't want to leave, but remember, when I quit, you quit. Sincerely, your heart.
Listen to your heart. Don't let it quit on you. High blood pressure can lead to a stroke, heart attack, or death. Get yours to a healthy range today. Find out how at heart.org/bloodpressure. A message from the American Heart Association, the American Stroke Association, and the Ad Council.
All right. Welcome back to Lockin' It In with Deb and Pear. We are speaking with Aric Walker from, what was the name of your company?
Virtue
Aric?
Capital and the Thomas Group.
Okay. Okay, Aric, one concern that my buyers have is their home during retirement. So if their income will be less, and especially if their spouse dies and they can't pay the mortgage, or maybe they can, but it's really tight, and you've got a lot of equity in your home. Maybe by that point you've even paid it off. So if you have to sell it, then you have to rent, and your rent is going to be off the charts, because if you bought that house, let's say you have a mortgage of $1,200 a month, and 20 years from now, you have to rent. It's going to cost you $3,000, $4,000, who knows. You're probably not prepared for that if you've planned your retirement and you think, I need this amount of money. So, if the worst thing happens, I get cancer. Maybe I don't even need to go to a nursing home, but I'm going to have collectors calling me. It's going to be terrible. And my HOA is going to be complaining. And I could lose my whole investment in my house. So what can we do in the case of medical in particular to avoid that?
So there's a couple of things that can be done to avoid that kind of situation. So one of the things that people do is they need to have some type of life insurance to help them. Now, typically we buy life insurance when we're in our 20s, 30s, 40s, maybe 50s, because of the fact that
it's affordable.
Well, it's not very expensive.
But that only works when you die.
Well, we get it because we say, gosh, if we're a couple and one of us passes away, we have this mortgage. So Perrin got them this mortgage. It's $100,000, $300,000, $400,000, and it's
$1 million,
$1 million mortgage.
$2 million.
It's difficult when in today's society where we typically have two income earners in a family. It's difficult to take out one of those incomes and say, we don't have that income anymore. Now cover all the same debts with, just $100, $200 less for food per month. So what people ought to do is when they get ready to purchase a home, they should basically do a financial review, look at their budget and say, okay, now that we have a home, we really need to make sure that we have some life insurance to pay off the mortgage and to make sure that our goals are met. So our goals might be, if we have kids, we might say, okay, down the road there's college. If both of us aren't here to contribute to our retirements and to the college education and to pay the mortgage and the bills, if one of us predeceases the other, bad luck happens sometimes, then we need to have an influx of cash. And that influx of cash can be inexpensively done through life insurance. There's lots of different types of life insurance. So one thing is you get the free stuff at the bank. You know, we all get this letter from our bank saying, hey, here's some free life insurance. And that's good to take. I always take it, and I tell.
Noticed that.
Well, I always tell people, take whatever's free to you. So if you get something from your bank saying, here's some free life insurance, most likely it is accidental death and dismemberment. And that will pay you if you die in an accident, or if you lose a limb or sight or hearing or something like that. So take it, it's free. It's usually $1,000. So I have 2 or 3 banks, and I have $2,000 or $3,000 free policies. Take it. It's worth having. Doesn't cost you anything. They do that because their partners, and I just did the air quotes, their partners are going to offer you some more. Now, it's not very expensive, but that type of insurance only pays you in the event you die in an accident. What you really need is you need some life insurance that will pay you if you get sick and die, or if you die of natural causes. If people do die, even young people, of heart problems or other issues suddenly. An aneurysm, different things happen. And so you want to make sure that you have good coverage. So maybe you get some term life insurance. Now, term life insurance is for a time period, a term. 1 year, 5 year, 10 year, 20 year, 30 year. So you get that. You also might get some life insurance free at work, or maybe you pay a little bit for it. It's really easy to qualify. I recommend to everyone I always talk to, if the work, if the job, if the career gives you life insurance, take it and look at buying a little more at work, because it's usually very easy to qualify for.
It's a lot cheaper.
And it's way inexpensive. It's cheaper than, I'm a broker, it's cheaper than I can get you. But I also recommend, not only do you have what you get at work, but you have your own, because if you leave the job,
it's gone.
Sometimes it's gone.
Sometimes you can
sometimes it's portable.
Yeah.
Sometimes that's the case. But the other side of the coin is when the company provides it, I've seen companies that, for whatever reason, maybe it's budget or whatever reason, they drop that insurance. Now you are having to get new life insurance. You're older than you were.
It's more expensive.
It's more expensive. Maybe you're not as healthy as you used to be. So you want to take care of your own situation. And the first rule in buying insurance should be, I don't buy more than I can afford. So you may find out that I need to have $1 million coverage because I make $50,000 a year and I want to cover for the next 20 years. But if you can't afford the $1 million, get what you can afford. It's non-taxable death benefit in almost every case, so it's a good thing to have.
And I think the important thing, too, to remember is that you need to buy it when you're healthy. The younger you are, the healthier you are.
Supposedly.
The better it is. If you wait, then the cost will go up. Maybe you'll be uninsurable in a week. Who knows?
That's correct. And if you suspect, and I'm not trying to game the system, but if I'm having problems, a good time to get that life insurance is before I tell my doctor about my problems. So if I can wait and get my life insurance taken care of, then I'll be okay as far as that's concerned. And then I go into the doctor and say, well, I'm having this issue. It's not life-threatening, but, it's a less expensive route to go. The other thing you look at is, let's say I'm in my 30s. I might at this point also plan for when I'm in my 60s and 70s. Not only did I get this inexpensive term insurance, but I might want to look at something more permanent so that when I'm in retirement, I don't have to go get a new term insurance policy. If I'm 70 years old and I want to have $1 million of term insurance, it's going to be like a house payment.
Yeah.
And there's no guarantee how long that policy will be affordable to me. So it's a good idea to, when I'm younger, to plan. We all see on TV, if you're watching Jeopardy, you see certain companies that offer you guaranteed acceptance or you can't be declined insurance.
Yes. That's like $10,000, $20,000, $30,000.
It's small dollar amounts of coverage, and it's better than nothing. But when the insurance company doesn't know anything about you except your age and your sex, it's very expensive. They're taking a high risk. So what you want to do is, if you're healthy enough to qualify, you want to answer all the questions, you want to do the blood tests, you want to get the medical records, all that kind of stuff, because you'll get a better deal. Everybody wants a good deal. They want the best price. So when I talk to folks, I say, let me ask you a few questions and take some notes, and then I'm going to shop it. I have companies I work with where I shop it so that I can get you the best price. So that's important to do also. So there's just a ton of different types. What you need to do is talk to somebody who will ask you a lot of questions and who is a broker. If you go to a company that just offers their own stuff and they don't broker it, then they're not necessarily looking out for your best interest as a client. They just offer you what they offer. And
Which
they don't
might
have
be a really good choice of products.
They might have good products in some area or another, but I found that companies that do a really good job, say with house and car insurance, may not have the best deal on life insurance.
Certainly, yeah. The all-in-one brokerages maybe wouldn't be as specialized as brokerages which only do life insurance. For
Exactly.
Sure.
If you call me up and say, Aric, can you get me a quote on car insurance and house insurance, I'm going to tell you no. Let's go to somebody who does a great job, who does that all day long, every day. That's the kind of thing to look for.
Yeah. All right, Aric. Thank you. Okay. We have a Facebook page, and also we have a website, lockinitin.com, and if you go there, you can listen to all of the episodes that we've ever recorded, and there are 4 of them there now, and if you've missed our show, we'd love it if you check them out. You can enter it into your podcast software or just listen to it on your computer. Okay, Aric, we have, and I'm hesitant right now to go here because of the time. So we will do it when we come back.
Please hold. Your call is important to us.
Walker Fairway Independent Mortgage Corporation provides national strength and hometown service for you when you purchase or refinance your dream home, investment property, or vacation home. Contact Perrin today at 253-226-6454 or apply online at perrin.walker@fairwaymc.com. Fairway, we serve people. Fairway Independent Mortgage Corporation, NMLS number 2289, is an equal housing lender. LO NMLS 226890. This is not an offer to enter into agreement. Not all customers will qualify.
Listen, as a hiring manager, I've got to tell you, the best job candidate isn't always the typical candidate. Sometimes they're a grad of life.
Meet the grads of life. Young adults of unique determination and experience. An ideal fit for your company in an entry-level position, internship, or mentorship. They might not have every qualification you typically look for, but they're exactly who your company needs.
Sometimes the best candidates aren't the ones you're used to.
Go to gradsoflife.org to learn how to find, cultivate, and train this great pool of untapped talent. Brought to you by the Ad Council and gradsoflife.org.
Dad! Come on! Over here! Look at this, Dad! Over!
Whoa. The moment my son saw a redwood tree
It's huge!
is the moment I knew that for him,
You can't even see the top of that thing!
even the sky has no limit.
There are some moments only the forest can inspire. Find yours at discovertheforest.org. Learn about forests near you and discover cool things to do when you go, like hiking, biking, fishing, or camping. Or do your own thing when you get there with family and friends. Your moment is out there. Find it at discovertheforest.org. That's discovertheforest.org.
Brought to you by the U.S. Forest Service and the Ad Council.
All right, welcome back to Locking It In with Deb and Pear. Had to stop dancing before I could speak. I really love that music. Okay, we're in the studio.
Rock on, Deb.
Yeah, so much fun. We're in the studio with Aric Walker. And Aric, I think we need to talk about Medicare and healthcare. What happens when you get to a point you think you need to sell your home? Would you recommend doing that?
So there's a couple of tricky things involved in this territory. What happens is, let's take an example. Let's say that I'm 79 and a half years old. I'm having some trouble at home. I need some help. I don't have the assets to maybe hire somebody to come into the house. I don't have some long-term care insurance, but I need some help.
That's where Aric comes in.
So a lot of times people will say, well, gosh, I think Medicare will help out. Well, Medicare helps out for those situations where you go to the hospital or the doctor. They don't help out for chronic illnesses. They don't come into your home and pay to have somebody help take care of you and take care of those things we call the activities of daily living, like bathing and dressing and feeding you and giving you your medication and helping you get to the restroom and those kind of things. So what happens is, let's say we have a couple and they have some assets. They have to spend their own assets down to a level where they almost have nothing. Now the difficulty there is that leaves, when one of them passes away, that leaves the survivor with almost nothing. They're impoverished. And so then what happens is they try to qualify for what's called Medicaid, which is the federal government and the state government helping out to cover those chronic illness costs. They'll allow a certain amount of time per day to pay for somebody to come into the home to help if that's possible. If not, then the person has to go into a nursing facility, into a nursing home. And that costs a lot of money. And so people will say, well, gosh, maybe we should sell the house and give us some cash so that we can, basically not have to go into the nursing home or pay for the adult family home or the nursing home. We like to look at the situation with the individuals and, if possible, avoid selling the house, because to qualify for Medicaid, you don't have to sell the house. It's an exempt asset. You can have, as a single individual, you can have a whopping $2,000 that you don't have to spend. Anything above that, you have to spend it before Medicaid or the federal
so
and state
you
government.
Can't save enough for a new roof if you're on Medicaid.
You can't. No. So you can only have $2,000 as a single individual. You can have a car and a house that's worth $500,000 or less. If you have more than that, you have to spend that before you qualify to get the state and federal government Medicaid to help you out. If I have a home, and a lot of times folks that are in retirement, they don't have a very big mortgage or they paid off the mortgage, they may want to look at something called a reverse mortgage. Now, some folks will look at that and say, oh, no, I can't do that. Well, a reverse mortgage...
They've changed.
Well, tell us a little bit about those, Perrin. What kind of reverse mortgages are there?
The best kind, in my opinion, is the FHA reverse mortgage, which we offer at Fairway. In fact, I was talking to a family yesterday afternoon about doing just that. Their mortgage payment currently, between the two, first and second, is about $800 a month, and with the reverse mortgage, their payment would go to zero, and they could get cash back on top of that, like about $30,000 in their case.
So they could do like a line of credit?
Yeah, and they have commercial property that is for sale that's worth quite a bit, and when they sell it, they're just going to pay the reverse mortgage off, and then they'll own their house free and clear. And in the meantime, they won't have that $800 a month debt because they're on Social Security only right now, and so that $800 is really difficult for them to pay.
Well, that gives them also, let's say they're in a situation where one of them needs care, chronic care at home. That gives them a little extra money that they could hire somebody to maybe relieve the spouse who's taking care of them, give them a little bit of a break. They can get out and do the shopping and maybe just get out and relax a little bit.
Well, they like to RV, and so they can't do that currently, but with that $800 a month extra, they're going to be able to do that.
So for some folks, that changes the picture, and it gives them an option.
It really is going to for them.
What this does on the Medicaid thing I was talking about, when a person is receiving Medicaid, the federal government has something called the Estate Recovery Act. It came in around the time of Bill Clinton. And what it does is it says if the federal and state government are paying for care for an individual, then the government can put a lien on the house. Now, if you have a reverse mortgage on your home, the government's going to think twice about doing that lien on the house, because you may potentially use all your equity and enjoy your equity where you're in control of that equity and that money. If you don't do that and you sell the house, as soon as you sell the house, you have a wad of cash, a lump sum of money, goes into your bank account. Now, Medicaid looks at that money and says, oh, you got a bunch of money. Before Medicaid will help you, you must spend this money down. For a couple, I don't know the exact number, but maybe it's around $50,000. For a single individual, it's $2,000, so not much money. So we like to tell people, hey, instead of selling the house and having just a ton of cash and being required to spend it all, and now you've got to find a new place to live and a new situation, why don't you look at your other options? You might look at that reverse mortgage. You can still live in the house, and
there's no payment.
You have control over the cash. You know, if you get a line of credit, you have control over that cash. How much are you going to take out? That's up to you. You could still potentially qualify for Medicaid while you have that reverse mortgage. It's a loan, so it's not quote-unquote income.
It's not an asset, right?
It's not going to go on your tax return. It's not going to affect how much of your Social Security is taxed. It's not going to affect you paying more for Medicare Part B or D. So it's kind of a good situation for some.
Is it tax deductible? I know there's nothing to deduct, but
the funds that you get from the mortgage?
Yeah, because you are paying interest on it too.
Well, I would recommend you talk to a CPA about that type of thing. And not being a CPA, I don't really want to go down that road. So that's a good question for a CPA, but it is a loan. So if you go back to, hey, I need long-term care insurance, I need things, those things help you so that when this Estate Recovery Act comes in, when Medicaid comes into the picture, you can either delay that or never have to deal with this type of situation. Okay. But it still gives you an option.
Okay. So one other question I have, this is something that I've encountered before. I'm not a big fan. There are life insurance policies available to protect someone's mortgage. I'm thinking this is you're paying a premium for the lender to protect the lender, and if you need that money, that life insurance for something else, you can just use it for some. I don't know. What is your opinion?
So a lot of times they call that mortgage life, and I look at that and I say, well, if I got that mortgage life and I have a 30-year mortgage, maybe my balance is $200,000. Let's fast forward that I have this policy 25 years. Now, if you look at how mortgages pay down, it's in the last 5 to 10 years where the balance goes down a lot. You're paying a lot of principal in the last little bit.
And the insurance goes down with it, right?
No. Whatever you got for your policy,
that's the same payment.
That premium payment that you're paying,
it's not a decreasing term?
You're paying the same amount for that insurance. So you're actually getting less bang for your buck the farther you are into this policy. Why not instead get a term life insurance or some type of a permanent life insurance where the dollar amount of coverage is the same for the dollar amount you're paying? You're not getting less payoff like on the mortgage life protection.
So you would recommend that in many cases that someone would get regular life insurance, term or
some type of a permanent.
You can get term for the amount of the mortgage, right?
You can, and then you can when you're 29 years and 11 months in, and the balance on the mortgage is only $1,000, and you pass away, and the mortgage life protection pays off that $1,000 of mortgage, and you were paying what you could have had maybe $200,000 worth of death benefit. That's not a good situation.
That's a tragedy.
Yeah.
It makes a lot of sense what you're saying.
The other side of the coin is you want to have the person who receives the death benefit receive the death benefit and decide at that point
what they want to use it
what
for.
they want to use that for.
Yeah, things change. Maybe when you buy it, you have different needs than.
Maybe they need to come call Debbie up and say, Debbie, I need to sell this house. Yeah. So instead.
Yeah. Okay. Yeah, or even downsizing is sometimes good as well. Definitely, we don't want mortgage insurance. Okay, so is there anything that you think is super important for people to keep in mind when they're considering life insurance, whether to protect their home or their income?
I think a lot of times people delay getting different types of insurance or doing things, and what they need to do is they need to just act.
Okay, Aric, thank you very much. You've been listening to Lockin' It In with Deb and Pear. If you enjoyed the show, please tune into our Facebook page at Lockin' It In. We'll see you next week.
Hasta la vista, baby.